In 2008, one of the most respected names on Wall Street borrowed roughly $30 for every $1 it actually owned. It had survived the Great Depression. It had survived 2 world wars. And then, in a single weekend, it was gone. That company was Lehman Brothers. And the thing that killed it wasn't a bad product. It was debt. Here's what most people get wrong. They think debt is always bad. It isn't. Some of the greatest companies on earth use debt brilliantly. Others use the exact same tool and dig their own grave. The line between the two comes down to one simple number on the balance sheet. Learn to read it, and you'll spot fragile companies before the market does. Let's start simple. The debt-to-equity ratio is just total debt divided by shareholder equity. That's it. If a company has $200 million in debt and $100 million in equity, its ratio is 2. $2 of borrowed money for every $1 the owners actually put in. So what's a good number? It depends on the business. As a rough guide, under 1 is conservative. Above 2 starts to raise eyebrows. But context is everything. A software company with a ratio of 2 should worry you. A regulated electric utility with a ratio of 2? Perfectly normal. Why the difference? It all comes down to one thing: can the business reliably pay the interest? And that's where it gets interesting. Here's the trap. Debt magnifies everything. When times are good, it magnifies your gains. But when times turn, it magnifies your losses just as fast. Look at Toys R Us. In 2005, a group of private equity firms bought it for $6.6 billion. But they didn't pay with their own money. They loaded the company with around $5 billion in debt. That debt forced the company to pay roughly $400 million in interest every single year. $400 million. Money that couldn't go to updating stores, or fighting Amazon, or lowering prices. The business wasn't even unprofitable at the operating level. But it was drowning. In 2017, Toys R Us filed for bankruptcy. By 2018, the stores were gone. The lesson? Debt removes your margin for error. A healthy company can survive a bad year. A heavily indebted one often can't. And here's the kicker: the more debt you carry, the less control you have over your own future. Now flip it around. Because debt, used wisely, can be a tool of genius. In 2013, Apple did something that confused a lot of people. It was sitting on more than $100 billion in cash. And then, it borrowed $17 billion. The largest corporate bond sale in history at the time. Why would the richest company on earth borrow money? Because it was smart. Much of that cash was parked overseas, and bringing it home meant a huge tax bill. Borrowing at rock-bottom interest rates was cheaper than paying those taxes. Apple used the debt to reward shareholders while keeping its cash working. That's the difference. Apple borrowed from a position of strength, with the cash flow to cover it many times over. Toys R Us borrowed from a position of weakness, and the debt controlled them. Utilities do the same thing. A regulated power company has predictable, almost boring cash flow. People pay their electric bill in every recession. That stability lets it safely carry debt that would sink a tech startup. So debt to equity tells you how much leverage exists. But there's a second number that tells you whether the company can actually survive it. It's called the interest coverage ratio. It's simple. Take the company's operating income and divide it by its annual interest payments. If a company earns $500 million and owes $50 million in interest, its coverage is 10. It can cover its interest 10 times over. That's a fortress. But if that same company only earns $75 million against $50 million in interest, coverage is just 1.5. One bad quarter, and they can't make their payments. This is why Warren Buffett has long been cautious with leverage. He said something along the lines of, "It makes no sense to risk what you have and need for what you don't have and don't need." He's seen it again and again. Smart people, good businesses, wiped out not by bad ideas, but by borrowing too much. So here's the principle to carry with you. Debt is neither good nor evil. It's a multiplier. Put a multiplier on a strong, stable, cash-rich business, and you get Apple. Put that same multiplier on a fragile, struggling one, and you get Lehman Brothers and Toys R Us. Before you ever invest in a company, look at two numbers: the debt-to-equity ratio and the interest coverage ratio. One tells you how much risk is on the table. The other tells you whether the company can survive it. Now I'm curious. Have you ever bought a stock without checking its debt? Be honest, I have, early on, and it cost me. Tell me your story in the comments. And if this changed how you'll read a balance sheet, hit subscribe. We do this every single day. Tomorrow, we're tackling a metric Wall Street loves to manipulate, and it might be hiding in a company you already own. Remember, this is educational content, not financial advice. Always do your own research. Past performance never guarantees the future.